In this educational series, we'll be discussing what the portfolio theory is. This would help us break down what systematic and unsystematic risk is, which is going to make the understanding of CAPM in subsequent readings much easier. So let's jump in. In the previous videos, we learned how to calculate the cost of equity using the dividend discount model, and I'm sure you are well versed with that now. The second method to calculating your cost of equity is your CAPM, the capital asset pricing model. But before we jump on to CAPM, we need to get an understanding of what the portfolio theory is. You cannot expect questions regarding the portfolio theory in high-level exams. However, an understanding of the underlying concept is very important if you want to tackle CAPM in a smooth way. So, I mentioned earlier that it'll help us getting an understanding of the factors that impact risk. We need to get an we need to know what risk is exactly. The higher exposure an investor has to risk, the higher return he or she would demand, right? So what is risk? Let's say Walmart paid out dividend of 1.92 in 2014, 1.96 in 2015, and thereon kept increasing its payout by 4 cents each year. Investors developed an expectation from Walmart that these guys are going to pay us dividends each year with a growth of 4 cents. However, what no one was able to predict was that the world would be taken by storm by a pandemic. That pandemic has increased the business risk, which in return has impacted the bottom lines for many businesses, including Walmart. How has it impacted Walmart? Consumers are unable to go to their stores. For example, let's say consumers are unable to go to their stores because of tightening of social mobility, and additionally because of the restriction in social mobility they were unable to make deliveries at an adequate amount of deliveries. So Walmart is unable to turn their inventory into cash, which consequently is negatively impacting their revenues and thus negatively impacting their bottom line. And they may not be able to pay out dividends at the same growth rate of 4 cents that they have been doing in the past 5 to 6 years. They may end up paying even lesser, that could be assumed, that could be anticipated. Maybe this time instead of paying an increased amount of 4 cents, they may decrease it by 4 cents, or they may even bring it down to 1.5. You never know. So this risk of fluctuation in future dividends is what creates your risk. In some years it may be more, in some years it may be less. I repeat, in 2020 it is highly likely that firms may cut out the dividend. They may give a lesser payout than anticipated because everyone's facing high business risk in this scenario. Alright, what creates risk? I mentioned at the start of the video that we will be tackling systematic and unsystematic, which is also known as idiosyncratic risk. So what creates risk? Systematic and unsystematic risk are the two factors that contribute to the creation of the total risk. A high-level summary of what systematic risk is that changes in the economic factors such as interest rates, exchange rates, inflation that may negatively impact a business's potential to create profits, to generate profits. What is unsystematic risk? Unsystematic risk is the risk that is associated to the company. It is company specific risk. For example, changes in some policy that may not impact the business as well as it anticipated. Changes in a managing director, a new CEO who might bring in new policies which you never know may be good or bad, or maybe the new CEO is very inexperienced. You never know. These kind of risks are your unsystematic risks and are associated with the company or company specific. Let's dig down a little further. Risk created as a result of changing economic factors which impact the earning potential of companies and exists in all industries is called systematic or market risk. Changes in exchange rates, inflation, interest rates trading volumes, foreign investment inflows and outflows are an example of systematic risk. Level of systematic risk is different in different sectors. For example, take the oil sector. You take OGDC, you take Pakistan Petroleum, etc. These sectors will have similar level of systematic risk. You can, for example, say each of these companies within this sector would have a systematic risk of zero point 0.3. The banking sector may have a systematic risk of 0.5. It depends on how sensitive their earnings, how sensitive the impact of changes in economic factors impact their potential to create profits. Let's have a look at unsystematic risk. Each company has a set of unique risk profile they are faced with, such as poor labor relations, new managing director, like we discussed. Poor labor relations could lead to more strikes. As a result, could create production issues. The company, as a result, may not have adequate amount of inventory present to meet the demands. So mixing what we've learned with systematic risk, for example, all banking sector companies may have similar systematic risk, like we discussed earlier, of 0.5 or 0.4. However, each would be faced by a unique set of risks on their own. Such risks are called unsystematic, idiosyncratic, or company-specific risk. So let's mix what we've learned. In the banking sector, we've assumed a systematic risk of 0.4 across the board. HBL, UBL, MCB. However, company-specific risks would be different for all. HBL may have an unsystematic risk of 0.7, UBL may have an unsystematic risk of 0.8, taking your total risk to 1.1. MCB may have an idiosyncratic risk of 1, taking their total risk to 1.3. So I repeat again, systematic risk may be same across the same sector but different across different sectors. Unsystematic risk is company specific. It completely depends on what's going on in that company. A few more points to go through before we lock in this concept. Companies are faced by both risks, total risk, systematic and unsystematic risk. Systematic risk is set in place. Investors cannot do anything about the economy. Systematic risk cannot be removed, but a different level of systematic risk could be chosen. You could go for a banking sector systematic risk. You could go for the banking sector instead of the oil. It just depends on your risk appetite. Always remember. Moving forward, unsystematic risk could be reduced by creating a portfolio. So say you have investment in MCB, which we assumed has a total risk of 1.3. Separating the systematic risk, they have an unsystematic risk of 1. It was way too risky for your risk appetite, so you chose to go with a less riskier bank. A bank that has a lesser unsystematic risk. So you picked one with an unsystematic risk of 0.3, combine that with your systematic risk, which is same across the sector of 0.3, and you got a total risk of 0.6 versus your current investment that had a total risk of 1.3. So you brought down your total risk because you diversified, you created a portfolio, you spread the investment in different companies. So it could be safe to say that creating a diversified portfolio could help in reducing your unsystematic risk. You cannot reduce your systematic risk because you cannot do anything about the economy, because investors cannot do anything to changes in interest rates, exchange rates. So it is safe to say that your systematic risk stays in place. However, investors are in control of the unsystematic part, And they can bring that down by a significant amount if they choose to diversify. They can diversify away the unsystematic risk. Let's have a look at a graph to lock in what we've learned. So we have the number of shares on the x-axis, we have the total risk on the y-axis. The part above the red dotted line is your unsystematic risk. The part below the dotted line, the red dotted line, is your systematic risk. The green line that is sloping downwards is the investor who is diversifying his unsystematic risk away. He kept buying stock with lesser idiosyncratic risk and he brought it down to an acceptable low level. It flattens out at this point because you cannot do anything about systematic risk. It is the risk that is linked to the changes in the economic factors. Our key learning points here would be shareholders, we're assuming shareholders are well diversified. What does this mean? That they kept buying, they kept spreading out their investment, kept buying stocks to bring down their unsystematic risk, and they have eliminated a substantial amount of unsystematic risk, say 95%, and now they're left with the systematic risk alone. Over here, by shareholders, we don't mean individual investors such as myself or you. We probably cannot afford to, build up portfolios worth billions and diversify away our unsystematic risk. Over here, by shareholders, we're assuming large institutions such as banks and other corporates that have large equity books. If you check the annual accounts of 2019, you will find that UBL has a pretty large equity book of around 18 billion. These are the kind of investors who can diversify away the unsystematic risk and be left only with the economic risk. Moving forward, since shareholders are diversifying away a substantial amount of unsystematic risk, say 95%, we can assume it's 100%. Could it be safe to say that risk exposure they have left is that of systematic risk? Yeah? Good. Moving forward, we can also now assume that they are expecting returns only based on that level of systematic risk to which they have exposure to. Since they have managed to eliminate the unsystematic risk by diversifying away their portfolio, then we can assume that they are demanding the level of return based on the systematic risk alone. Additionally, the level of systematic risk would depend on which sector or mix of sectors we invest in. That brings us to the end of this video. We're going to take what we learned here and we're going to use it in subsequent videos on the capital asset pricing model. And this theory should help us in tackling that topic with ease. If you like the information, please be sure to subscribe. Hit the bell icon for updates. The next video series would be based on the capital asset pricing model. Very important model. Very interesting as well. It's a must know for people who are in the field of finance. So hit the subscribe button. I'll be uploading the video soon. Thank you very much for your time.